Hi, my name is Jordan Eich, and I'm one of the wealth managers here at Howe Rusling in our Rochester office. For some investors, holding cash provides the safety and security that they desire, but it's actually not without risk. Because of inflation, the value of cash can actually deteriorate over time as your purchasing power goes down. So $100 today is unlikely to buy you the same amount of goods next year, let alone 5 or 10 years from now. In recent years, investment alternatives to cash have really gained in popularity, and part of this began with the sharp rise of interest rates in 2022. In this new interest rate environment we have now, investors have been able to earn higher rates of return on investment alternatives to cash while still taking limited amounts of risk. In fact, if we look at Federal Reserve data, money market fund deposits have grown by 39% from the fourth quarter of 2022 to the fourth quarter of 2024. There are so many investment alternatives to cash. So today we're just going to focus on 3 options: the money market fund, certificates of deposit, and bonds. So what is a money market fund? Well, money market funds are a type of mutual fund, and it invests in low risk, short-term debt securities. They're designed to offer you a safe, stable investment option for money that might be needed for an emergency or a short-term goal. Money market funds are an investment product, and they're usually offered within a brokerage account, and they're different than money market accounts. Money market accounts are most often issued by a bank or a credit union. So what are the pros of money market funds? Well, first of all, they're meant to be safe. They're not intended to lose value. They are also extremely liquid, and you can withdraw your cash at any time without penalties. Generally, they have higher yields than what you might get from just a regular bank savings account. On the flip side, what about some of the cons of money market funds? Well, first of all, they don't carry FDIC insurance like a bank account or a CD might. Money market funds, they might be eligible for coverage under SIPC if it's held within a brokerage account. Because a money market fund is a mutual fund, it sometimes takes a few days to transfer cash to your bank account. So shares are going to need to be sold, settled, and then transferred. So make sure you have plenty of time set aside for money movement. The rate of return that you receive from a money market can also fluctuate based on the interest rate environment. So if rates go down, your yield is likely going to follow and go down a little bit as well. From a high level, in summary, money market funds are liquid, they're stable investment where you can earn a flexible rate of interest over a given period of time. Now let's take a look at certificates of deposit. You'll most often hear of a certificate of deposit referred to as a CD. A CD is essentially a savings account. It pays you a fixed rate of interest for a set period of time. These set periods of time, though, can vary depending on what your time horizon is. Some of the most common CD terms are 3, 6, 12 months, but sometimes they can range all the way up to 10 years. And they're often issued by a bank or credit union. If the bank or credit union is backed by the FDIC or NCUA, your deposit may be insured against loss, making it an extremely safe investment. So what about the pros of CDs? Well, number one, rates are typically much higher than a money market or savings account. The rate of return is also predictable, and it's locked in for whatever the term of your CD is. So if you need to earn a certain return over a specific time period, then that could make a CD a really good option. They're also generally insured against loss, again, if it's opened with an FDIC or NCUA insured bank or credit union. There's often limits to the dollar value of that insurance coverage, so just make sure you check with the issuer and confirm what those coverage levels are before purchasing. On the flip side, cons of CDs, well, number one, if you withdraw the funds prior to the maturity date, you could actually be subject to penalties, and that's going to limit your investment return. If interest rates go up during the holding period, you may also miss out on maximum upside. For example, if you own a 12-month CD and it's paying, let's say, 4%, and 3 months into your holding period, rates go up to 5%, well, you're going to have 9 months where you're locked into this CD earning less interest than what is available to you currently in the market. So in summary, CDs, they could be a really good option if you're looking for a set rate of return that's backed by FDIC or NCUA insurance. Just be wary of the lack of flexibility, so if you end up needing to withdraw funds sooner than expected. Now let's take a look at bonds. So what is a bond? Well, it's issued by a government or an individual company, and it pays a stated rate of interest called a coupon payment. Now, they offer varying rates of interest and overall return based on things like the quality of the issuer, the length of the bond term, the overall attractiveness to buyers. With a bond, what you're doing is you're essentially loaning money to the issuer, where they agree they're going to pay you back your money on a date in the future, which is called the maturity date. Now, along the way, they're also agreeing you to pay interest along the way in the form of semi-annual coupon payments. Bonds are in general viewed as less volatile than stocks, but they still carry risk. And the risk of a bond is measured through what's called the credit rating. Companies with a higher credit rating are thought to be less likely to default on the bond than one with a lower credit rating. Bond issuers with lower credit ratings often actually have to pay a higher rate of interest in order to make their bonds attractive. And what that's really doing is it's compensating investors for taking the risk of buying that lower rated bond. While there's a bunch of different types of bonds and bond issuers, I want to focus on the ones issued by the United States government, and those are called U.S. Treasuries. Now, U.S. Treasuries are issued by the U.S. Department of Treasury, and they're designed to raise money that's needed to operate the federal government. It's considered a really safe investment option because it's backed by the full faith and credit of the U.S. government that guarantees interest and principal payments are going to be made on time. Now, while their credit rating was recently downgraded by Moody's, and Moody's is the global credit rating agency that evaluates the creditworthiness of borrowers, they're still considered a really high quality and liquid investment. You can buy treasuries with different types of maturities, which represents, again, the time before your principal investment is returned to you. So they range from 3 months, which are called treasury bills, all the way to 30 years, which would be a treasury bond, and then most everything in between. Now, what are the pros of bonds? Well, first of all, there are certain tax advantages that bondholders receive. For example, U.S. Treasury securities are exempt from state and local taxes. And bonds also offer the ability for your investment to fluctuate in value. So if interest rates fall during your bond holding period, it's likely that the actual value of your bond is going to increase. And that's because you now own a bond that's paying a higher rate of interest to you than what's available on the rest of the market. So that creates demand and ultimately can push the value of your bond up on the secondary market. On the flip side of that, looking at cons, well, just as falling interest rates could push the value of your bond up, the opposite can be true as well. So if interest rates go up during your holding period, it could push the value of your bond down. Just remember that you always have the option to hold that bond until the maturity date without selling it, where you would receive the full value of your investment back, so long as the issuer of the bond doesn't default prior to the maturity date. Another consideration when you're investing in bonds is that they're generally not FDIC or NCUA insured like a CD, so you want to be sure to vet the quality of the issuer before making an investment. And then another factor that holds bond investors back in general is just the overall complexity of investing in bonds, so evaluating credit quality, selecting appropriate maturity ranges, things of that nature. So for this reason, some investors will outsource that to a professional investment manager. Overall though, bonds, while they provide higher upside to investors potentially, it also comes with additional risks, and that should certainly be considered. Now, while any of these could be the right option, which one ultimately that you choose depends on your individual goals, objectives, your time horizon, your risk tolerance. And so understanding the options along with the pros and cons is really a great first step toward making a good decision. So just make sure talk to your financial professional, reach out to Howe Rusling to learn more, and make sure you're making the most out of your alternative to cash investments.